The JMF Advisors Show is a podcast for business owners, C-suite executives, and entrepreneurs who are looking to build, grow, or even exit a business.
We bring in some of our best financial advisors to interview experts on business best practices, hot topics, and sprinkle in some tax and accounting help.
If you're a business owner, startup founder, CFO, or just starting your side hustle, this podcast is for you.
Hello, and welcome to the JMF Advisors Show. My name is Rachel Taylor. I'm a co-chair of the tax department at JMF, and I'm joined today by Lauren Roberts, who's a tax manager at JMF. And the title of our podcast episode today is Do You Know?
Yes.
So what are we going to know today?
Okay, I thought it would be really good to cover some topics that we think people should know or that we get a lot of questions on. And so my first topic comes from Instagram.
Perfect.
Which I love Instagram, and I love following interior designers on Instagram. So a lot of these interior designers aren't really interior designers. They're actually just people who have a passion and love for interior design, and they use their home as their own medium. So they're just decorating their own home, and they're gaining a followers and posting pictures. Yeah. And I noticed a lot of time they buy and sell homes pretty quickly. You know, they fix up their home and then they sell it and they do it again.
Yeah.
And I'm like, do they know? If you hold on to this home for 2 years, you can exclude, a big chunk of gain.
Right.
And so I wanted to go over the home gain exclusion rules, which if you're married filing joint, you can exclude up to $500,000 of gain, or if you file differently, you can do $250,000 for single or married filing separate. So there's two tests that you can qualify for this gain exclusion. So it's the ownership test and the use test. So you have to own the home, and you also have to use the home as your primary residence, your main home. And you can do that in any 2 years in a 5-year period. So you don't have to both own and use it in a same 2 year period in the 5 years, which is kind of interesting.
Yeah. That's probably the biggest test, right?
Right.
Is I need to live in this house for 2 years.
Right. Mm-hmm.
Yeah, that's kind of that first hurdle that people have to get over.
Yes.
It can't be a year. I mean, it can be. There are some exceptions, but generally speaking.
And I'll touch on those exceptions.
Yeah.
So you have to, any 2 years in a 5-year period, and you only get to exclude the gain in 1 2-year period. So you can't have, within the 5 years, you can have 2 2-year periods and sell in 5. You can't do that. You can only exclude it in 1 2-year period. And there are some exceptions to that. So, big exceptions, I'm not going to cover them all, but, divorce, death, you can there's some exceptions to that.
Right.
And then there's some partial gain exception rules. So those are work related. If you have to move more than 50 miles or more related to work, or also health related. So one of the people I follow, I'm not really sure if they had 2 years, but it was close, but they have autoimmune disease. So they lived in a state with a harsh winter climate, and their doctor said if you move to a more temperate climate, you'd probably do better with your autoimmune disease.
Yeah.
So if they didn't meet that 2-year test, they could get partial gain exclusion. And then another one is really funny, unforeseeable events. So there's a varying list of those, but one of my favorites is in the same pregnancy, if you have 2 or more kids, you can get out of it. But if you just have 1 kid, you don't meet that unforeseeable event. So
It's only unforeseeable if it's more than one.
That's right. If you live in a studio apartment or 1-bedroom
Right.
condo, you're kind of out of luck if you have 1 kid.
Right.
But if you have multiple, you can't. You just stick them in the broom closet or, some sort of Harry Potter situation.
Right. You're on your own.
Yes. So there are some exclusions. And then also I wanted to talk about just briefly how you calculate your gain.
Yeah. Okay.
So you start with your basis, which is either if you bought the property, it is what you paid for it. It could have been gifted, which you would get the person's basis that gifted it to you. And then if you inherited it, it would be the fair market value on date of death.
Yes.
And then to that, don't forget, you also get to add to your basis any major improvements you have. So a new roof, a new HVAC, not general repairs. So like if you fix a leak or you pay someone to mow the lawn, that doesn't add to your basis. And then also when you sell the property, you have cost of sales. The realtor commission is a big cost. You get to add that to your basis to calculate the gain. But if you've ever depreciated the property, so if it was a rental property or you depreciated through the home office deduction, you have to back that back out. So that reduces your basis.
I've always kind of felt like the IRS really wanted you to be able to exclude this gain, because if you really dig into it, there are so many exceptions or partial exclusions and all that. Like, so if you do sell a home and if you didn't meet the real obvious test, it makes sense to really dig into it and see if you can meet one of these other tests.
Right. And it's a great thing if you meet it. You know, you just have to own it and use it for 2 years. And then you can exclude the gain. And same for, if somebody's even just flipping rental property. I know it's not fun to live in a property during renovations, but if you can make it work out where you can own and live in that property for 2 years out of a 5-year period, you can exclude the gain, and that could be your business, flipping properties. So it's a really good exclusion to know about. And a couple other things to note, you can't get the exclusion on a second home or vacation home. It has to be your primary residence.
Important.
And then also another question we get a lot, can you deduct the loss?
Oh, yeah.
And you cannot deduct the loss. The IRS has a rule on personal use property, so you never get to deduct a loss on like your main home. And same for second homes. So even though you would have to recognize the gain on a second home, they don't let you deduct the loss either. So that's a bit of a bummer.
Tricky,
to think about. And that's really all I have on the home gain exclusion.
Yeah.
And I also thought it would be really good to touch on what home expenses are deductible. And then you can't talk about those without talking about the few expenses the IRS allows us to deduct that are personal, which are itemized deductions. And since the Tax Cuts and Jobs Act increased the standard deduction, we have a lot of confusion from clients, do I take the standard deduction or do I itemize, and that sort of thing. And do you want to touch on those for us?
Yes. So we do a lot of times get questions from people about personal expenses. Can I deduct my HOA fees? Can I deduct my driver's license renewal, my home repair?
Yes.
And generally the answer to any of those personal questions is no, you cannot deduct that. Can't deduct your utilities, all that kind of stuff. But like you said, the IRS has these limited categories of itemized deductions that you can take, assuming that you have enough to exceed that standard deduction. For home expenses, your mortgage interest is probably the most obvious one. Most people know about that one. You get that Form 1098. It's got your home mortgage interest, and a lot of times it has your real estate taxes if you pay those through escrow. Both of those are deductible on your as an itemized deduction. If not for federal, a lot of times for us in Alabama, we can deduct those. A lot of people itemize for Alabama. There is a limit, just like there's always a caveat on these things. For home mortgage interest, the rule now, if you've taken out your mortgage since December 15th of 2017, then if your outstanding principal balance is over $750,000, your home mortgage interest deduction is limited. It was $1 million before that.
Right.
Some people are grandfathered in, but the most recent amount is the $750,000. So those are big ones. Medical expenses, those are tough because of that floor that you have to meet. So it's 7.5% of your AGI. Doesn't sound like a lot, but that is a lot.
It is.
That people have to get over. So your general annual medical expenses that most people have don't usually qualify. Significant medical expenses, maybe a major surgery, nursing home expenses, those things are worth keeping up with because those usually can equal a medical deduction, but then you still have to get over that hurdle of the standard deduction too. So sometimes it doesn't work out. State and local taxes, we mentioned the real estate taxes, car tags, there's a portion of that that's a tax. So that part's deductible. State estimated tax payments that you pay, that kind of thing. But those are all limited too.
Right.
Since the Tax Cuts and Jobs Act, that's limited to $10,000 or $5,000 if you're not married filing joint. So but that's still, all that kind of stuff starts adding up. Mortgage interest we discussed. Of course, we have charitable contributions. Most people know about those. And all that added together sometimes still doesn't exceed.
Right. It doesn't get you over it.
Right. I would say 85% of our clients don't itemize. It's a large number. Now that's for federal.
Right.
Alabama's different. because the standard deduction's so low.
Yes, and that's really recent from the Tax Cuts and Jobs
Right.
Act in 2018. Some people are still confused because it used to be way more easier to itemize.
Sure.
But since that act increased the standard deduction, and the purpose was so you didn't have to itemize. But unfortunately, a lot of states follow federal in those rules, but Alabama does not. And so Alabama has a really low standard deduction, so it's really
right.
easy to itemize on Alabama.
That's right. And there are a few other personal expenses we get asked about too. Things like, a lot of them are work related. Things like commuting, parking.
Since the pandemic, home office,
Home
if you're
office.
an employee.
Yep. All that stuff. If you're an employee, you're kind of out of luck on that stuff. With the exception of if you have uniforms, that's one that like something you wouldn't wear outside of work.
Right.
So nursing scrubs, that kind of thing. That would qualify, but it's not great.
Right.
It's a miscellaneous itemized deduction on your Alabama return.
Right, because with the same act we're talking about, it acts miscellaneous itemized deductions for federal.
Right.
So you don't get it.
So
It's a bummer.
it kind of is. And commuting doesn't count anyway.
Yeah, anything, even if you're self-employed, commuting is always considered a personal expense.
And that includes parking.
Parking, right.
If it's parking at your regular job,
Regular
location.
office.
Yeah, yeah.
If you have to visit people to pay for parking, like clients and that sort of thing, that's deductible. But not if it's every day, like if JMF, we're downtown, if we didn't have our parking lot and we had to pay in a parking deck or something, that's considered commuting.
Okay, that makes sense. Now, if you're self-employed, it's different. As far as some of these expenses go,
Yes.
some of these commuting it's still personal.
It's still personal.
But some things can be deductible if you're self-employed that are more difficult to deduct if you're an employee.
Right,
But
like
as
the
a
home
general rule,
office.
right? The home office is a big one. That's a big one. And now that we have the simplified home office calculation, it makes it
Yes,
easier. But
it's much easier.
As a general rule, these personal expenses not
Not
deductible. If they are, you're not even going to hardly notice it.
Right,
It's
exactly.
a small impact.
Yes.
But one thing that has come up recently, speaking of homes and home improvements, is these
Yes.
energy credits.
Yes.
Now, we've had energy credits for a while.
A long time.
But they're kind of hard to keep track of. They come and go, they expire, they get renewed.
Yes.
The dollar amount's pretty limited, so sometimes you'd have to spend a bunch to get a
Yes.
relatively small credit.
And they're limited.
Yeah.
Very tiny.
But now they've been
Yeah.
expanded and they're actually a lot more beneficial.
Yes. So I'm going to talk about those. And it was the Inflation Reduction Act that recently passed that kind of gave us a boost in those that makes them a little bit more appealing. So you can get tax credits for energy efficient home improvements. And these are things like insulation, windows, exterior doors, water heaters, furnaces, AC units, that sort of thing. So the old credit was super minimal. It was 10% of the cost, capped at, get this, a $500 lifetime limit, which is like literally nothing when it comes to a home improvement. And then some certain individual improvements had an even lower limit, like windows were capped at $200. Not very beneficial. But now the new credit, you can get up to 30%, and it's capped at $1,200. And the lifetime limit is gone, so you can do $1,200 annually. And there's still some individual limits on items, like now windows are $600 instead of $200. So it's a nice boost, and it's a nice thing to keep up with. And there's this excellent website, EnergyStar.gov, and you can go on it, and I think we can have the link to this. Yeah. And you go on it, and they have a picture of like insulation or windows, and you can click on it. So if you're thinking of doing a project at your home, you can click on it. It tells you what percentage of credit you can get, what's the maximum credit, and then it tells you the criteria, because obviously it has to have some sort of energy efficient rating that meets certain criteria to qualify for the credit. So it's a really beneficial website, especially because they're so confusing.
Right.
and hard to keep up with.
Yes, very.
And another new thing is second homes qualify now. So if you have a vacation home, you can get energy credits for these improvements, but not rental property. Rental property doesn't qualify.
That's good to know.
And there's also, if you're willing to spend the big bucks on clean energy, like solar panels or a geothermal heating unit, that sort of thing, there are bigger credits that are 30% of the cost, but they're not limited to that $1,200. So if you have something, definitely reach out to your accountant. The website's really good for the small improvements, but if you want to do something bigger, let's discuss and make sure, it qualifies and that sort of thing. But they got a boost, and I think it's a good thing for sure.
Yeah, I agree. And that's good that it can be on a second home too.
Yes, it is.
That's nice.
Yes. And so another thing I wanted to cover that did you know is lately I've had a lot of really young, retirement-minded clients contributing to Roth IRAs, but unfortunately, they make too much money.
Yes.
So then I have to tell them, well, you can't contribute to your Roth, and we have a few options that we have to get the contribution out. And so I thought it'd be good to talk about some of the rules related to IRAs.
Yes, because we do get a lot of questions about IRAs, and it can get tricky.
Mm-hmm.
So most people know we have two main types of IRAs we're going to talk about here. There are more, but we'll talk about the traditional and the Roth because most people are pretty familiar with those. Mm-hmm. So the traditional, people typically think of it as I get a deduction when I make a contribution, and then when I take distributions out when I'm retired, those are taxable. Mm-hmm. And the Roth is basically the opposite. I don't get a deduction when I make a contribution, but then as it grows, I take a distribution in my retirement age, it's not taxable. Mm-hmm. Okay, that's what you're talking about. Yes. That's what people want.
Right.
But unfortunately, there's some relatively low income caps on those for people. So we got the two types. The distributions are taxed differently. We'll talk about the traditional just a little bit. So, because a lot of people like to contribute to those. They like that deduction, which is good. You can contribute to a traditional IRA if you have earned income or if your spouse has earned income.
Right.
So at least one of you needs like wages.
Mm-hmm. And it's a great way for if you're a stay-at-home parent, you get to contribute to retirement as long as your spouse has earned income.
Yeah. So that's great. I see a lot of people doing that. So that's a really good thing. The contributions would be due by the due date of the tax return for the previous year. So if it's April 1st of 2023 and you want to make a contribution for 2022, you can. Mm-hmm. You can also make one for 2023 all at the same time. So you've got until the due date of the tax return by the April 15th or whatever it is that year, it can change, to make one for the previous year, which gives people a little extra time maybe to see what
can they do it?
Can they do it? Yeah. What does my tax return
Can you do the Roth?
Right, exactly. Mm-hmm. What does my income look like? For 2023, the contributions amount limits are $6,500 for people under 50, $7,500 for people 50 and over. So that's the max. And then you can make a traditional deductible IRA contribution or a non-deductible IRA contribution. In order to make the deductible, if you're covered by an employer retirement plan, there's a income limit. So your AGI, if you're married filing joint, has to be less than $136,000. So if it is, and you're covered by an employer retirement plan, you can still make your deductible contribution. If it's over that, then you're phased out. You could make a non-deductible, which some people do, and then we would file Form 8606, keep up with your basis. That's still an option. And so that kind of two different ways you can go there. With the Roth, since it's not deductible, it's kind of an all or nothing. You can either do it or you can't do it. The income limit is higher, but it's AGI of $228,000 for married filing joint. About half of that, well, I guess a little bit more, $153 for single if you're filing single. So those are the limits. That's what you're talking about.
Right.
People whose income is higher than that, they still make a Roth contribution, but they're not eligible. Yeah. So that's tricky. You can contribute to both a traditional and a Roth, but your total contribution has to be less than that $6,500 or the $7,500.
So sometimes in that phase out threshold, you could do it. $2,000 you can do to Roth. You just can't do the whole thing. Sometimes it's phased out to zero. So you could do the rest to a traditional if you want.
That's right. And these are all great things. Some people like to, you want to give to your employer retirement plan if that's an option.
Yes.
But some people like to supplement that a little bit.
Right.
This is a great way to do it. Or maybe you don't have an employer retirement plan, then this is a great, easy way to make a contribution. Or like
the stay-at-home spouse who doesn't have employer retirement plan. But some I will say some employer retirement plans, like we have a Roth option 401k. So it doesn't matter what our income is. We can still do the Roth option. You don't have to. There's no limit on that because it's a 401k plan. But the IRA, it is not. And it is important, if you're just doing traditional and your income's too high and you can't deduct it, it is still important, like you mentioned, the 8606. We should get that contribution on an 8606 because it documents you have basis in that contribution. So if you ever were to take it out in retirement, a little tiny portion based on whatever values in that plan may be not taxable. Mm-hmm. Or if you don't have a lot of value in your traditional IRA account and you have that non-deductible basis, it may make sense to go ahead and convert it to a Roth and what we call a backdoor Roth, that sort of thing.
Yeah, I see a lot of people doing that. That's a really valuable tool too. If your income's too high, but you still want to contribute, you can do that. And I think a lot of the investment companies out there that host IRAs are very familiar with those. Yes,
because you really now, it used to be, I think now that our tax rates are a little bit better, you see a lot of people wanting to do a Roth. They really wanted that traditional deduction and they'd pay the taxes later. Mm-hmm. But now, and a lot of times with, money podcasts and that sort of thing, people are like, Roth. Yeah. And it can grow tax-free and you don't ever have to pay taxes on the growth, that sort of thing. So they are really popular, but only certain people can do that.
And that information doesn't always make it out there.
Yeah, exactly.
You hear about the Roth, but you don't hear about the fine print that comes along with it.
Yes, and that sort of can lead us, if we're done with that, into my next topic.
Sure.
So another really popular thing, if, I love to follow money podcasts or read money articles, and you always see the article where, they're like 35 and they built all this passive income flow and they've retired early and they're just living off their passive income. And usually that passive income is from real estate investment, so rental property. Mm-hmm. So I wanted to talk about the passive activity loss rules, which I think we talk about rental investment, but they don't talk about the passive activity loss, which means the loss is limited.
Yep.
So when you have a rental property, you have your rental income, and then you get to deduct the expenses you have against that. And so, that's mortgage interest, if you pay the utilities, that sort of thing. If you pay a management company, their 10% fee, you get to deduct the expenses, repairs, and then you get to depreciate the property, which is usually a big deduction. Mm-hmm. So when you buy the property, you have to split a portion to land that you don't get to depreciate, but the rest of the value you get to depreciate over 27.5 years, and that's for residential rental. If it's commercial rental, it's 39 years, much longer. But we're really talking about most people are doing residential rental property. Sure. And it's depreciated over 27.5 years. So with that depreciation, we really don't see ever a lot of profit on these rental properties. They're always a loss, but you don't get to benefit from that loss. It's called the passive activity loss rules. And so you don't get to deduct the loss unless you have other passive activity income, which some clients do, but most of them don't.
Yeah.
So you really have to kind of wait it out until it gets profitable,
right?
Which can be many years or decades before you start to take those losses. Or if you sell the property, then that frees up all those losses and you can deduct them when you sell the property. But you should know there's not benefit. Had a new client this year and they bought a rental property and they owed and they were like, well, did you get all my rental deductions? And I was like, well, I guess now's a good time. I didn't know they were interested in rental property, so I hadn't just given them the rules yet.
Right.
But it's important when you're going to make an investment like that, always ask your preparer, what are the tax consequences of these things, or tax implications, that sort of thing, because you can't deduct the loss. They just they're going to build up until you have other passive income, you're not going to benefit from it.
Yeah. And a lot of people don't think about that because they don't know those rules.
Right. They don't. Mm-hmm. And we're not going to just school them if we don't know they're interested.
That's right.
It's like really random. We have to know you're interested to give you those rules. So it's important to know that if you invest in rental real estate, which is really hot thing to do right now,
right?
Those losses aren't deductible. It's the passive activity loss rules, PAL. And so it's really important to look at that because you're not going to get a tax benefit from it unless you happen to have other passive income to offset it.
And there are certain exceptions. There's that little bit of that rental,
Yes,
but your
yes.
income has to be low enough.
Yes.
So it's all very specific to your
Yes.
situation.
If you're in a lower income, I can't remember quite, it's like 150 or 125,000. If your AGI is not over that,
Yeah.
you do get a $25,000 loss.
Yeah.
So that does help. But I guess with our clients, we don't really see that a lot.
Exactly. Usually people are phased out. So that's why it's like you said, if this is something that you want to do, especially if you're thinking about maybe acquiring multiple properties or doing this long term, it's not just kind of a short term thing, maybe,
Right.
then definitely talk to your tax professional about it and get them to look at your specific situation so you'll
Yes.
know. I mean, maybe you're okay with that, but
Right.
it's just good to know that going into
Yeah.
it.
I mean, going along, you are building, you're paying down the property, you're owning the property
Yeah.
and that sort of thing. And building towards the future, maybe when you retire, it is, a profitable thing, that sort of thing.
Yeah, there are other benefits to having it besides not all tax related.
Yes,
but,
yes.
But you don't want to be surprised and owe money when you think you're not going to.
Right.
That's a bummer.
You can't benefit from that loss
Yeah,
usually.
yeah, exactly. Well, we have a couple more things we can talk
Yes.
about.
These are things I didn't know
Oh.
that you brought up.
Oh, everyone learns
Yes,
today.
yes.
So in the most recent Alabama legislative session, we got a couple of new benefits these are for 2023. So these aren't things that you would use on your 2022 tax return. A lot of people probably have seen in the news a lot of talk about sales tax on groceries. That's not new.
Right.
We've talked about that for many
Yes.
years, but it's resurfaced this year in this about last few months. So one thing that Alabama has done as a way to sort of repay people for their grocery sales tax is to give people a one-time rebate. So if you're an Alabama resident, you filed a 2021 tax return by that October 15th, I think it was actually the 17th, deadline of 22. So you filed your 21 tax return on time, even with the extended due date. Then you're eligible to receive a one-time rebate. The dollar amount is, I wrote it down. It's $300 for if you're married filing joint, $150 if you're single. And Alabama has been instructed to make those payments starting after November 30th of 2023.
Okay.
So I don't know exactly when that's going to come,
Yeah.
but I read the act and it's no sooner than November 30th of 23. So if you normally receive your refund by direct deposit, so Alabama has your banking information, then it'll just be direct deposited. If they don't, then you'll receive a check. It's not taxable, so it won't show up as a taxable income on your 23 return. But the information that's out there is that it is designed to be a somewhat of a rebate of your sales tax paid on groceries for 21.
Okay.
So
Interesting.
So yeah, nice
And-
little bonus there.
And so we don't get it on a tax return.
Right.
Like it's not like a credit or something that they're going to send with our refund. They're just going to mail it out later
right.
this year.
That's right. So kind of like the stimulus payments that we
Yeah.
got. It's not on your tax return. It'll come through direct deposit. And unlike some of these other things, you don't have to keep track of when you got it, how much you got.
Oh, gosh, yeah.
Yeah, we don't have to reconcile it at least
Yeah.
unless something changes. Because it's not taxable, I don't think we'll have to. I didn't see any kind of income
Right.
limitations, anything like that. I think
That's
it's just,
nice.
yeah, so nice
Interesting.
little legislative
Yes.
grace there. The other one that I think I had some clients actually ask me about this during tax season because I think they saw it in the news, even though it doesn't affect 22. It starts in 23. So if you ever look up good places to retire, Alabama is usually on the list because Alabama doesn't tax Social Security, doesn't tax state and federal retirement income like teachers' retirement, police, military, stuff like that, and any kind of defined benefit plan, which those kind of fall into. So a large chunk of people, their Alabama income, taxable income goes way down in retirement, which is
Right.
nice. But the people that leaves out are people who are living on 401k retirement plan distributions, IRAs, all that stuff is still taxable in Alabama. So I read that there has been a push for like 20 years to have, yes, I had no idea, to have a some kind of benefit, some kind of relief for people who whose retirement income is not excluded. So we get that for 23. If your retirement age of 65 or older,
Okay.
and you have taxable retirement income in Alabama, then the first $6,000 will be excluded from your taxable income, which is nice. So that counts for IRAs, 401ks, things like that. So I think that's going to really...
That's excellent. Because, I mean, we really are super friendly to retirees in Alabama.
Yeah.
And this is even a bigger boost because I think it's funny that people push for it because a lot of states, you know, sometimes they do have a retiree thing, but like some states don't. Like recently I've seen a lot of clients move to like North Carolina, which I know is lovely, Asheville and that sort of thing.
Yeah.
But, you know, like the retirement system in Alabama is taxable now. And I'm like, you know, that's a big chunk of change to have to pay state tax on that. You know, so we're really retirement friendly, and now we're even more retirement friendly.
Come retire here.
Yes, I know. Is it permanent?
As far as I know, yeah.
Okay.
I didn't see that it wasn't. So, yeah, I think it is.
That's wonderful.
Yeah. So,
Yeah.
I know. I think a lot of people are going to be happy about that.
Yes.
I mean, it's, 5% of $6,000. It's not a ton.
It's not,
But
it helps.
It helps. And I don't know. I'm wondering if maybe that amount might grow over time. I don't know. But, if it's $6,000 this year, it might.
Inflation
Yeah,
adjust, that
maybe
sort of
index,
thing.
that kind of thing. Yeah. So we might see that grow a little
And
bit.
it really is, when you're thinking about retirement, it is really important to look at how a lot of people want to retire to a different state, how that state taxes your retirement income because, that's state taxes can be significant.
Yes. Yes, absolutely. Yeah.
I'm glad we're friendly towards that.
Yes. Bodes well for us.
Yes.
Yeah, absolutely. What have we not covered? Have we covered it all?
I think that's about it that I have for today.
Okay.
Yeah.
Well, I think this has been great. Thank you, Lauren, for all your information. And thanks for everyone for listening and joining with us today on the JMF Advisors Show. Remember to like and subscribe wherever you listen to podcasts. And also go find us on YouTube. You can subscribe there and get updated whenever we post something new. So thanks again, and we will see you next time.
If you would like us to help your business or would like to suggest additional podcast topics, simply send an email to info@jmf.com.
And don't forget to subscribe to our podcast on YouTube and your favorite audio podcast apps.